Hi, my name is Ray Kamiena, coming to you from Baltimore, Maryland again. Wanted to do a little bit of a follow-up to my last video about the 401k Chaos book by Andy Tanner. Again, if you hadn't watched my last video, Andy Tanner actually wrote an ebook which is absolutely free. You can get it online. Highly recommend that you read it. It really enlightened me about how these 401k works. Just want you, recap. A 401k is very similar to a 403b, an IRA, a TSA, TSP. Very similar to those programs. They all were formed during the ERISA Act of 1974, which stands for the Employment, Retirement, Income, and Security Act. And that was when it was born. And basically, it was supposed to supplement the three-legged stool of retirement, which was Social Security, pension plans, and of course, this is what we call a defined contribution, where you're actually putting money in to have a retirement. Now, you know there's not many pensions plans out there nowadays. Those have gone away. Social Security is actually in trouble. We'll do another video about Social Security. So that's actually getting in trouble right now. So really, 401k Chaos, if you don't know what that's really all about, this video hopefully will share some good things about it. Now, one thing about it's very good, it's a tax-deductible account, meaning that if you had money, 10% or up to 15% of your income put into a 401k, we'll just call it 401k generically, but basically they all work the same way. So let's say you put in $10,000 into your 401k, and that $10,000 you were able to write off against your $100,000 income. So minus $10,000, because it's 100% tax deductible, your adjusted gross income is $90,000. So that's what you have to pay taxes on. Now over here, on the $10,000, you actually save $3,000 in taxes, assuming just regular 30% tax bracket. So it seems like a good deal, doesn't it? But when this $10,000 is tax deferred, grows to $100,000 down the road, okay, $100,000 down the road, now you're going to pay a tax deferred rate. And again, you have to ask yourself, where are taxes going in the future? Well, let's assume they stayed about the same with 30%. That means you're going to pay $30,000 in taxes when you could have paid $3,000 up here. Okay, now I know $3,000 is actually good. You don't want to pay $3,000 right now. But if you don't look ahead, you might actually get yourself in a big problem in deferring your taxes, because that's what the program is. It's actually a tax deferred account, and you then have to ask yourself where tax is going to go in the future. Everyone I speak to think the taxes might be going higher because we have a big federal deficit and we have a lot more people getting dependent on our social services. Now, another thing about that plan, which a lot of people don't know, that plan, you know, if you've invested in 401k before, you know it fluctuates. It goes up and down, kind of like an investment. Well, most investments that you do out there, we pay tax on capital gains, and that capital gains is usually about 23%. But in that book, 401k Chaos, they actually got us because they charge us income taxes, not capital gains taxes, income taxes, which is as high as 36%. So almost double what we're supposed to be paying, because it is somewhat like an investment. The last thing that you're going to do, which a lot of people don't know about, the fees, 2 to 3% that you get charged on this. All of the underlying investment money in there is usually managed by regular money management companies like mutual funds, and all of them have fees, and these fees can run anywhere from 2 to 3%. So what that does, you may not even get to $100,000. When people project this out, you might actually get half of that, $50,000 instead of $100,000, because of all the fees that you have to get charged every year, and that's whether you're making money or not. So that's pretty interesting that I even didn't know about until I read that book. The last thing is accessibility. First of all, you can touch your money before taxes, before retirement, before the age of 59 and a half. Well, what if you have a lot of money there? You'd like to touch it. But if you weren't 59 and a half, you'd have to pay 10% penalty plus those taxes if you needed to touch that money before retirement. So you have limited accessibility to this money that you've saved up in here. It is your money, but you have to realize you are a partner with the government. Because when the government tells you you can tax deductible and then let your money tax deferred, they're your partner to tell you what you're going to pay at the end. So that's all I have for you right now. Look for my next video, and I hope this information was good for you. Hi, my name is Ray Kamiena. It's my pleasure to share this information with you today. I'd like to let you know that I am a licensed insurance agent in Maryland and the surrounding states. I am not a tax advisor nor a financial planner, although I do have about 20 years experience in this industry. If you have any interest in the information you watch today, you can certainly contact us, and we also recommend you also consult your tax and financial professional. Thank you.